The debt ceiling deadline is around the corner and the stock market's sitting at very critical resistance. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart. See what's going on in the stock market today. All right. Today's SPY was up 0.04%, so we went absolutely nowhere, and we're still getting rejected from that critical resistance zone right around SPY 420. Now, very simply said, the debt ceiling does matter, but we need to see the price action agreeing with us, and we can't become bearish while the chart is still bullish, and right now the chart is still bullish while SPY is above 417. Remember, SPY above 417 is the higher high breakout from the February 2nd high. So being above that level means we are still in short squeeze territory, and we still do have gaps to fill at 421 and 425. So while we can speculate on what might happen, we can only trade what the chart is giving us. And right now, if you're shorting this market, you need to cover if we break out above 420, or you need to get more bearish if we break the support at 417. Bigger picture, I'm not getting bearish until we can at least break down to a lower low, and that's going to require a break of the support, which is right here at 414. So even if we break below 417, you still have some strong support down here right around 414. So if you're bearish, manage your risk right here at 420, which I do consider a critical resistance. But because we are in short squeeze territory, you shouldn't be getting overly bearish until we can lose some of the support below and confirm a downtrend. So keep in mind, we have gaps at 421 and 425, but we also have gaps down here at 407, 401, and 396. And while we know all of these gaps are very likely going to get filled in the future, we have no idea exactly when. So the trend right now still favors the bulls while SPY is above 414 and 417. So we're not getting bearish until we break down below those support levels. Keep in mind, people have been trying to call a top in this market all year long, and it continues to grind higher, which is known as climbing the wall of worry. There has been a narrative all year long on why the market should go lower and not higher, so the debt ceiling is just the most recent narrative. We've had plenty of narratives before the debt ceiling that told us the market needed to go lower, yet here we are and the market is currently sitting near year-to-date highs. So as I always tell you, let the chart and the trend and the price action do all the talking, and right now they're all still bullish. On the NASDAQ 100 triple Qs, we were up 0.34% today, and the triple Qs are still closing near my critical resistance zone between 337 and 339. I really don't see a lot more upside in the triple Qs until we break above these strong resistance levels. And it does look like we went a little too far too fast, which is evident by 2 days ago closing outside the upper Bollinger Band. Usually when we get this far overextended, we are at least going to go sideways to down before we go any higher. So I'm not looking for a ton more upside in the NASDAQ 100. It doesn't guarantee I'm right, and that doesn't guarantee we have to go lower. However, I would heed caution here, and I would not be expecting too much more upside in the triple Qs right now. Likely downside targets would be a retest of the breakout at 333 and 327, and that is also going to be about where the rising 20 daily moving average is going to be in just a few more days. Keep in mind, to the downside, we have gaps at 315 and 308, and while we don't know when those gaps are going to get filled, we do know there is a very good chance those gaps are going to get filled sometime this year. So just be aware that the triple Qs are looking a little too far overextended, and even though everything is still looking very bullish, we have a lot more downside until we get to strong support levels. Also, very quickly, if we jump over to the 10-year yield, you can see in the short term, it is having a higher low and a higher high breakout, which is telling us that the rates are starting to climb. And as you know, as rates are going higher, that is going to be a headwind for tech stock. Jumping over to the Dow Jones, we were down 0.39% today, and the Dow Jones is actually still in a bear trend while it's trading below that resistance at 336. Remember, in the Dow, we have gaps to fill at 329 and 322, so we're not getting bullish until we can get a daily close above critical resistance at 336. The next bear breakdown will be a breakdown below 332, and then I will be looking for that gap fill at 329. And if we break below the 200 daily moving average, I'll be looking for the gap fill at 322. So in the Dow Jones, it's very simple. It's heading lower until we can break above 336. On the Russell 2000 IWM ETF, we were up 1.22% today, and we now are the second day back over the strong resistance at 176, so the small caps are looking a lot more bullish in the short term. We did close outside the upper Bollinger Band, so we're getting a little too far overextended, and the next likely upside target will be this gap fill at 181, and a test of that negatively sloping 200 daily moving average. Now keep in mind, we are still below a negatively sloping 200 daily moving average, so we are still in a longer term downtrend in the small caps. So don't get overly bullish. Once we close that gap, we need to break through that resistance and confirm an uptrend. You could stay bullish as long as we're above 176, but if we break below 176, I will be looking for the gap fill below right around 171.56. And we do have a valid head and shoulders breakdown if we start closing below 170. On the ARKK ETF, we were up 4.86% today, and we are sitting at very critical resistance at 40.5 up to about 41.5. I consider this a level you could short from because we are still in a downtrend until we start clearing through this resistance zone. So it's low risk to short here, and we have lots of downside reward at the gap fills below 36 and below 32. Again, those gaps don't have to get filled anytime soon, but there is a good chance they will. So if we do start to see high volume selling from the strong resistance zone, this could be a great shorting opportunity. However, if we start closing above critical resistance, it's instantly a bull trend because we're going to start breaking out and climbing to the higher prices in the mid 40s. On the VIX, we are up 2.26% today, and overall the VIX is still suppressed down below 18 and down below 20, and there's just no way we're going back into a bear market until the VIX spikes out above 20. So right now the VIX is still telling us low fear, which confirms the bull trends. So we need to let the price action do all the talking and wait to get bearish until the VIX spikes above 20. On Bitcoin, we're currently up about 0.65%, and Bitcoin is sitting at one of those bounce or die support levels at 27,000 because if we break down below it, this is going to look like a confirmed double top and head and shoulders pattern, which could take us back down towards 24,000. Again, it's a very simple risk level at 27,000. We're either above it or below it, so let the price action guide you from here. And as you can tell, we are in a bear trend now that the 20 simple moving average is crossing below the 50 EMA. On Tesla stock, we were up 4.85% today, and Tesla has hit all of my upside targets, which was the gap fills at 177 and 183. And as you can tell, we are way outside the upper Bollinger Band, so even though we are getting a bull breakout above 183, we are getting a little too far overextended, which means we are going to be due for a pullback. The pullback would be a retest of this breakout at 183, and then above that, we're still looking for price targets at 197 and the negatively sloping 200 daily moving average right around 200. If you look at all of the big tech stocks, Tesla is one of the few that are still trading below the 200 daily moving average, so there's a very good chance Tesla still can break out and go to much higher prices. Again, I'm not calling for that right now because we are a little too far overextended. So if you're bullish, manage your risk at the breakout at 183 and the 50 EMA at 176. And then you're looking for those upside targets at 197, 200, and 208. On Apple stock, we were down 0.55% today, and Apple is still in a bull trend as long as it's trading above about 171. If we break down below 171, we will be looking for downside targets at 167 and 163. And we do now have a gap to fill just below 175 because we did gap down this morning. So we now have gaps to the upside and the downside. So even if we do start to bounce to the upside, look for the possibility of a lower high before the next lower low, because it does look like Apple could be peaking and getting ready to go through a correction. If you zoom out and look at this Apple bull run, it has been very impulsive and very strong, but we know nothing can go up forever. So yes, there is the possibility Apple is about to roll over and go through a correction. On the financial sector, we were up 0.18%, and the financials are finding resistance right where we were looking for resistance at 33, so we can't get bullish until we get the confirmed bull breakout and start to make a higher high. If we do get rejected, we're looking for the lower low down at the gap fill at 31. The industrials were down 0.02% today, going absolutely nowhere, and we're not getting bullish until we can clear this resistance above 101.5. On the healthcare sector, we were up 0.1% today, and the healthcare sector is trying to find support at the 200 daily moving average and support zone right around 130 to 131. A bullish bounce from here could take us to the gap fill at 137, but we're instantly risk off if we break below support. The energy sector was down 0.41% today, still looking bearish while it's trading below 80, and we still have that gap fill target below at 73, so we are still bearish until we can break above some of this resistance and start to show a bull trend. So jumping back over to the S&P 500, there is no doubt the debt ceiling is significant, but we trade the price action in the chart and we can't make any assumptions until the chart confirms what we're thinking with price action. So even if you have a bearish bias because of the debt ceiling, you need to let the price action prove we're going lower by breaking down through some critical support. If you get in the habit of letting price action confirm everything, you're going to become a much better, disciplined, and profitable trader. If you want to come trade with other price action traders and get access to all of my intraday updates and analysis, come join us over at the Stocks Channel Trading Discord community. I also have my own trade alert service called Bank Trade Alerts that will send you all of your buy and sell alerts directly via email and text message, and only trades the ETFs TQQQ and SQQQ. You can find out how to join Bank Trade Alerts or the Stocks Channel Discord by clicking on the links in the description of this video. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.